India is the country, from all of the statistics using 10-year growth rates and also just what's apparent, India will have probably the greatest growth rate, the fastest growth rate economically, have the greatest transformation of any country. And I would say, like, if I was going to paint the world, there is this great power conflict and lots of things going on that are great and terrible in both China and the United States. And then there's the countries that are not in that, the neutral countries. So here we are in the UAE, and you think about what's going on here and in Saudi and so on. Or you go to Singapore and you look at what's happening in the ASEAN countries, Indonesia, Vietnam, and so on, and you look at India. It's an advantage through all history and world wars. Those that have not been involved in the wars and stand aside from the wars actually prosper from whatever conflicts exist. So we're going to have different types of wars between those two states, but India is going to be. Now, the dynamic of it is very interesting because it's not really open. You know, it's dominated by a few families. It's not an easy place to get into, and the capital markets haven't developed it to the extent that they should develop. They will develop probably. So there's a great deal of potential, but actually, is there going to be that kind of opening up that is going to create that kind of vibrancy for us all? India will do great, I think, and then the question is, what does that mean for the rest of us?
The biggest issue is that there's more spending than we have income, and that's a problem. So then the question is, where are you going to get the money from? I mean, these things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And of course, that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt, then you have inflation, then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trash. Now cash is relatively attractive. You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash, all of that comes down. So you could see which sectors are going down. You could see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, and we're having something close to let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate, something like that. But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically growing. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt. But I think that this type of recession is not a bad recession. It's a lot less bad than I thought it would be because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world because we're selling all this debt. You know, if you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, okay? And now we're having a problem selling that money around the world.
Right.
And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds.